Welcome to Milestone Builders Show, episode 2. As you guys know, we make these episodes for all the investors, first-time homebuyers, anyone that want to know more about finance and real estate. With that being said, this is our second episode, and following up with the first one, if you already watched it or listened to it in a podcast series, we're going to talk about tax, since the tax season is here, and especially if you're a self-employed or business owner, you want to make sure that you file your tax properly if you have planned to purchase. With that being said, before we dive into this episode together, I'm going to give you a little bit more information about the purpose of this podcast. We make this podcast for anyone at any level, whether you're a savvy investor and you want to just get some today's updated information because things change. We're going to touch up on that a little bit as well today, as far as loan limits and all that, what happened from beginning of this year versus end of last year. So we can always update everyone on ongoing market situation. So pretty much any level. If you're a beginner, if you're a first-time homebuyer, or you're a savvy investor, you already bought 20 properties and this is going to be not your first rodeo, but you just want to be informed with what's going on in the market, this is where you be, and we're ready to answer all your questions. With that being said, please go to Milestone Builders Show. We put it in the screen on all podcast platforms like iTunes, Spotify, Google Cast. And also, if you're watching the video, please make sure, if you see this video helpful to you, subscribe, like the video, share it with whoever you think is benefiting them, so they can ask their question and we can answer them in future episodes. Today we have Brian. He's by far one of the best in the industry. He's not paying me to do that or say that. I mean it when I say that, because as a realtor, I worked with many lenders in the past, and they work differently. I'm not trying to say they're bad or good, but working with a lender that take stress off of you and everything goes smooth, and you know that if he says this client is approved, you consider it a done deal, it's a key for a realtor. Also, in the client standpoint, if you're trying to purchase a property and trying to buy it with loan, you want to work with a really good lender that know what they're doing. And I think by far, Brian is one of the best in the industry, not only in this city, in the entire industry. We're going to bring so many other professionals down the road, from title to other investors that already been investing, insurance. There's going to be all kinds of different materials in our podcast in the future, but today's episode is dedicated to tax, and if we get chance, we might dive into credit as well. With that being said, Brian, welcome to our show.
Right. Welcome.
Thanks a lot.
Thank you.
This is our second episode, and it's loaded with all kinds of great information. It was a crazy year.
Definitely was crazy.
And then this past month was even crazier as we dive into 2022. I know we're both very busy, and your time is very valuable. We're going to go a highlight of pretty much what tax has to do with people's qualification.
All right, so we've got a couple different types of income that are on the taxes. You're going to have your regular W-2 employee. Not much to talk about that. What your W-2 shows is what it's going to be on your taxes. You have your 1099 employees and your self-employed borrowers. And then there's a couple different variations with self-employed borrowers. So as a 1099 employee, you get a piece of paper that says you made this much money from whatever company. That's like, I pay somebody to do work for me, and I give them a 1099. I don't pay their taxes to the IRS. I pay them, and they're responsible for paying their own taxes. On a 1099, you put that on the schedule, what they call a Schedule C on your tax return. A Schedule C will say, how much money did you make from a 1099, or how much money did you make? You put that number in there. Later, there's expenses. And those expenses take away from the overall income, which lowers your taxable income.
Yep.
So that lowers the amount of money that you, as a taxpayer, have to pay the IRS.
So to be clear, taxable income is technically your total gross income minus deduction.
Correct. So you're going to have, but it's different than what you're going to see on page 1 of your tax return. Is going to have like your income, and then there's going to have some other deductions, and it'll say your taxable income on the bottom. That's not the taxable income that we would be talking about with a self-employed person. We're going to be talking about just what shows on the Schedule C. So the Schedule C will show I made $150,000 from a 1099. Or this could be a regular old self-employed borrower who doesn't have or file business returns, who has an LLC or whatever single member entity, somebody who's an Uber driver, somebody who, there's lots of different things where you get paid a 1099
Barbers.
or a barber,
So many of
where you don't own an actual company where you have to file a business tax return. It's just yourself. And so because of that, it'll have your total income that you claimed either by 1099 or that you're claiming that you made that year. It'll have all your deductions. Then the bottom line will have what that is, what the number is. So let's say you made $150,000 and you had $100,000 in deductions. Your taxable income's $50,000. You might be thinking, I make a ton of money. I make $150,000. This is so great. I can qualify for a $600,000 home. Well, the bank doesn't look at the $150,000 because you told the IRS it cost you $100,000 to make that $150,000.
Pretty much.
And so because of that, you're only paying taxes on $50,000. So whatever you claim that is your taxable income on the Schedule C is what the bank is going to use for your monthly income. They'll take that income and divide it by 12.
Okay, so as you guys see, there's kind of a complex situation going on with tax. And honestly, if you guys want to purchase a home in this year, or you have planned in the very close future, even in next year, you want to buy a home, you want to be prepared from now. And especially now that tax season is already here, we're already, what is it, February 1st? We're in it right now. So we try to dedicate this episode to mainly anything that had to do with tax, but it's hard to go over everything in depth because case by case things are different. Like there are some taxi drivers that they do get some income through W-2, but they also get cash tips. They can deposit that in their bank account. There's just so much thing that it's hard to put them all in one episode and explain, and it's different case by case. But one thing we can tell right now is, I guess if you guys want to, sit with us, we can go over everything. And if you're a buyer, it's all free. It's a free consultation for you, and you have nothing to lose. We're not charged. I get, as a realtor, I get paid from seller. Brian get paid from bank, and there's really no money out of your pocket for seeing us. Pretty much, it's a totally free informational visit. With that being said, let's touch on the loan types again and the difference of basically what is last year versus this year.
All right, so there's a couple of different loan types that are most common here in Las Vegas. One of the ones that you'll hear from if you just Google stuff like loan types will be USDA. Just forget about it here in Las Vegas. You're not going to get one here in Las Vegas. So if you're going to be in Pahrump or other outlying areas, those could be available. We can talk about those on a one-on-one basis just because they're so few people actually do them or know how to do them here in Vegas. But you're going to have your FHA, your VA, and your conventional. And then conventional has conforming and jumbo. So first, you're going to have an FHA loan. FHA's new loan limit this year here in Las Vegas or here in Clark County, it goes by county, is $420,620.
That's if your income approved. This is the maximum loan
maximum. So
anyone
let's
can
say
get.
you qualify for $1 million, but you can only qualify for an FHA loan. The maximum loan amount is $420,620. So that's the max you can get doing an FHA loan. But again, it's going to come down to whether you'd qualify for that or not. Next, you have VA. VA doesn't have a cap. They used to have a cap. They don't have a cap anymore.
I want to be VA.
Yeah. So VA doesn't really have a cap. Then third, you've got the conventional loans. Conventional, you've got conforming and non-conforming / jumbo. So your conforming is any loan amount 640,200, I think, or below. So anything below that number is a conforming loan limit, which means you can do it as like a Fannie Mae, Freddie Mac loan. You can underwrite it through an automated underwriting system, and you'll go off of all conforming guidelines or rules. Anything above that for a loan amount, whether it's just $1 or more, is a jumbo. And jumbo has their own set of guidelines. There's no automated underwriting system where you can put the information through a computer and it'll tell you, yes, this person's approved, as long as you provide proof of these, the following items. It's basically an underwriter looking at your individual paperwork and calculating everything manually and saying, okay, yes, I think this person will work and it'll be good. So that's kind of the difference between conventional jumbo and conventional conforming.
So pretty much if they're planning to not have their loan more than 620,000,
647.
647,
yeah.
The actual loan amount.
Yeah.
They can go with conforming.
It's like if you were to buy conforming loan amount, if you were to buy something for 650, you can put 3% down and your loan amount's going to be under the 647. You can buy 660, it'll be under the 647. So
let's talk about that 3% because there's a bunch of questions about it. So as you guys know, on FHA, always the minimum down payment required by FHA is 3.5%. But when it comes to conventional, we have as low as 3%, but if you qualify for it. So what's the qualification?
You can do 3% down if you're what they consider a first-time home buyer. A first-time home buyer is anybody who has not owned a home in the last 3 years.
3 years.
So if you've owned a home, and that doesn't mean just I had a mortgage. If you were on title of a house at any time in the last 3 years, you're considered an owner. So if your grandma and grandpa left you a house and you had your name on it and then you sold it, that you were an owner. You were an owner. If you were on there and your wife owned the home with you, or your husband owned the home with you and they were on the mortgage but you were not, you were still an owner of the property because you were on the title of the property.
Makes sense.
So it
has nothing to do with the loan.
Yeah,
but the question is, let's say if someone purchased a property 5 years ago, it's before 3 years.
Well, if they sold it before then yes. If they sold it before the 3 year time period, then yeah, you're a first time buyer in the eyes of the rules for the mortgage.
But if they bought a property 5 years ago, they still own it.
They're not considered a first time buyer because they are still owning a property.
Okay.
And it's been within the last 3 years.
That was a confusion for a lot of people. They tried to argue that, and I'm like, okay, well, don't argue with me. This is the rule.
Yeah.
Okay.
So yeah, if you own a home in any way, shape, or form, not that you bought one, but if you owned a home in any way, shape, or form, as far as being on title, being on the mortgage, whatever it might be, anytime in the last 36 months, if your name was on a title or on a mortgage, you're not a first-time buyer. Okay. You would then have to put 5% down with a conventional loan.
Okay. So it doesn't have to do with people's credit score?
So that's the other thing. So you can do 3% down as a first-time buyer. You can do 5% down, if you've owned a home in the last 3 years. But it all comes down to putting that information in the system for Fannie Mae or Freddie Mac and running it through their automated system. The automated system is going to tell you whether you're approved or you're not approved. And I'm going to tell you, if you don't have like a higher credit score, when I say higher, there's a couple different factors, but what I've noticed is if you are doing a loan by yourself, then you need a 720 credit score or higher. Sometimes even a 720 or higher, you don't qualify.
To be considered for 3% then.
Yeah, because they would, assuming they haven't owned a home ever, not even just in the last 3 years ever, but they have a 720 or a 730. Like I had somebody just recently, and I'll get to that in a second, but let's just say they have a 720 credit score. I have to run it through the system. The system analyzes the credit along with their income, their debts, and what their debt to income ratio is. And Fannie Mae or Freddie Mac will come back and spit out, yes, approved, or not approved, like refer, which usually means you have to fix something to make it work. And 9 times out of 10, it has something to do with like either it'll say, warnings, debt to income ratio high or loan to value too high or whatever it might be. So it'll tell you what the reasons are. But typically, if you have a 720 or better, you're going to get an approval. One that just happened recently, I had a client who wanted to put 5% down, and they had a 745, I think is what it was. But they had, I think, a couple of late payments that were several years old, and then like one collection, and their debt to income ratio was like at 40, and I think the maximum was right around 45. And I was like thinking to myself, no problem. They have a 745 credit score. It'll be no problem. Well, I ran it through the system. It would not approve with anything less than 10% down. Wow. So it just depends. Everyone's different. It's a computer algorithm. You have no idea. It's like the lottery. It's like the balls popping and it sucks one up and you don't know what it's going to be. It's the same thing when you put the information through the system. You could think that it's going to be approved. Like I've had some that I was like, there's no way this is getting approved. And then all of a sudden it's like approved. And I'm like, oh my gosh, I got it approved. So you never know. But yeah, so that's what it requires. Now, if you have 2 people on the loan, for some reason, when you have more than one person, it likes it better. So like you can have a 720 and the other person have like a 680 or a 660 credit score. The bank, the online underwriting system likes that better than one person with a 720. Everything else can be the same, but because there's 2 people, they like it better. The other thing too is if they're a W-2 employee compared to self-employed, it will analyze it, and then I've seen it say self-employment adds additional layered risk. So it just depends. Everything is so individual that I can't say, hey, if you have this, you're good. If you have this, you're good. It's sincerely 100% individualistic.
Exactly. So that's what I said earlier. Case by case, things are different. That's why the free consultation is there. You can reach out to us at any time. We'd be more than happy to go over everything. We're going to dive into another piece of qualification, which is credit. This can be a whole episode. We're just going to touch the tip of the iceberg on it. And then in the next episode, we're going to really go dive in. It's just going to be dedicated to that. Yeah, so let's talk about credit and its mystery, okay? And it has to do with all different kinds of loan, and it's a big, huge factor. What I'm going to ask from Brian to kind of clarify for us, first of all, for the most common loan, which is FHA and conventional, what is the minimum credit score that would qualify you? And then after that, how many score more you fall into a different category? Because that's what I'm saying, it's so complex. It's hard to explain all in one episode. So with that being said, let's talk about that.
All right, so we're going to go back and talk a little bit more about conventional FHA and VA credit scores and credit a little bit. With FHA, we'll start with that one. FHA and VA are both government-backed loans. They kind of mirror each other a little bit. FHA and VA, the minimum credit score requirement for most lenders that I've seen is about 580. It's most standard lenders. You're going to find some of those off-the-wall lenders or some lenders that will allow you to go down to 500. But when you go below 580 credit score, there's what they call overlays and other conditions they put on and make it difficult for you to qualify.
Definitely.
Like with FHA, below a 580, you're going to need to put 10% down instead of 3.5. And then anything above a 580 credit score, there's different credit tiers for like how you're going to get your pricing or your rate. So typically it's going to be, every bank's a little bit different, but it's going to be 580 to 620 is probably one price, 620 to 640 is another price, 640 to 680 is another price, 680 to 720, 720 and higher. So they have different tiers. And that's going to be for FHA and VA because they kind of mirror each other. Conventional is a little bit different. Conventional 620 credit score is the minimum, and then every 20 points is a different credit tier or different like hit to the rate or different price for the rate. So 620 to 639, 640 to 659, 660 to 679. That's how it works with conventional. Now, to get into credit a little bit and not just 100% go over a whole nother episode and spend another 45 minutes talking about credit. You can have a really good credit score, 680, 700, 720, and still not be able to qualify with that credit report or credit score. And kind of what I'm getting at is that there's times when you'll have a credit score pop up on your screen when I'm checking someone's credit. That credit score might say 720. And you look through the credit report and you look at it and you're like, wow, how is this a 720? They've got 16 collections and 14 late payments on different credit cards. And your mind's like, what the heck? Well, what happens is if you dispute an item, it doesn't factor into the credit score.
Yeah, those credit repair agencies.
Yeah. So when you do that, when they dispute an item, it doesn't factor into that credit score. So what typically happens is when I was a young loan officer and didn't really know much about this, I was like, oh, this person has a 680. Let's go ahead and submit the loan. We submitted the loan, and then I get an approval, and it's like, you're approved, but you need to remove the credit disputes off of this and this and this, and then rerun your automated underwriting system. And so, because it'll then give you your true credit score. Well, then you go in and you remove the disputes, and they go from a 680 to a 555, and you're like, well, I can't do the loan now. So when people tell you to dispute something, if it truly is not yours, dispute it, yes. And do what you can to get that off your credit by disputing it. If it's yours and you're just trying to not pay it, and you're just trying to see if you can get around, if somebody tells you, oh yeah, we can help you with your credit, and I'm a credit repair agency, or I'm a friend, you just got to go in and dispute it. What's going to happen is your credit score will get better for a little bit, while the dispute is going on, because then it won't factor into your score. But 9 times out of 10, it's going to go right back on your credit, and it'll be undisputed, and then you're going to have your score back to where it was in the beginning. And you end up wasting the time you could have had to actually get it figured out, dealing with just the dispute that works. I've seen probably, I wouldn't even know, I'd venture to guess 1,500 credit reports in my life, and if not more. And of the ones where people are disputing, I've heard maybe of those 1,500, I've heard of maybe 2 or 3 people actually having a dispute work where it removes something. That's like 99% of the time. For the most part, it just give them the illusion of, oh, my credit score improved when it's just in dispute. Yes.
But unless that dispute resolves, this is like illusional
it's like Coke
score.
Zero. You read the label on the back and you're like, this isn't Coke Zero.
Yeah. So let me clarify a couple of other things, because while Brian was talking, I was just trying to basically don't interrupt him. Brian said lenders or different banks. So this brings me to a point where I need to explain something so it's clarified for everyone. There's a difference between a typical loan officer. Let's say you go to your bank that you have bank account. Let's say you go to Chase, you go to Bank of America. Versus someone like Brian as a mortgage broker. When you go to Bank of America and they say, oh, we have our loan officers here that can qualify for a loan, they can only give you Bank of America's product or loan. Versus someone like Brian, he has deal with pretty much all the major mortgage companies out there, and he would go and shop around for our client and see who would give him better product with better rate. So at the end of the day, I guess this is a better route to go. So this will conclude our second episode of Milestone Builders Show. Please go follow our podcast on different platforms like iTunes, Spotify, and Google Cast. And also, if you want to see the video version of it so you can see my handsome face, just kidding, and my guest, please subscribe to our YouTube channel. We're going to put it on the screen. Next episode going to be dedicated to credit and everything that had to do with credit. Matter of fact, currently you guys have a chance to send us your questions so we can implement all those questions. So hopefully we answer them all in our future episode and be helpful. With that being said, follow us. You have nothing to lose but to gain. Talk to you guys soon.